it's bringing up my unresolved childhood traumas. And so really comes in handy. But that being said, I'm really glad I get to show this portion of screening sponsors to y'all, because this is how I started in the commercial real estate world, which was I had to figure out, who do I invest with? How do I minimize my risk? And then eventually starting to do my own larger projects. And so I'm pretty well equipped, or at least well adept at screening, because I am currently investing around 3,000 units as an LP. And so, and not just multifamily, and in other asset classes as well. And some have played out well and some haven't so much. And I'm going to talk about both a little bit. That being said, we're sponsored by Palace. If you are curious about figuring out where can I meet GPs, how do I learn more about this content, Perry is a friend of ours, and they changed the name from Cashflow Marketplace to Palace, but I would subscribe to the YouTube channel for short form content instead of this longer form hour-long meeting in which I hope I can tackle as many questions as I can. That being said, if you're looking to meet more GPs in particular and see what everyone else can do, I am not territorial. You should go on there and see what are other people doing and how are they competing against each other to stand out from the crowd, right? All right, that being said, hold on, give me a second. Is this the correct one? Give me 1 second. I might have downloaded the wrong slides. This format looks a little weird. It's different than the one that it had originally on Google, but I'm going to go from there. That being said, apologies for that. Normally these slides in this section, typically we just talk about the EDM method. I'm going to try to summarize it as quickly as I can. It's basically experience, deals, and market. When you look at the team and sponsors, you look at the product, you look at the location, that's typically how you package all this together to figure out, should I invest in this project with the sponsor? There's more than one way to go about it when it comes to evaluating sponsors. There's a way to look at the people, and there's a way to look at the process of going through and figuring out, do I invest with them? The people come first, obviously. That's how you build that initial relationship and figure out, do I trust this person? And eventually you should go through this loop and progress of figuring out, if I'm going to be investing, should I repeat it the same way so that I can tackle all the questions that I need to in the future? And we're going to talk a little bit about both. But the first step when it comes to figuring out the people is, who is actually on this project and what are they doing, right? There's 3 main roles that I'm going to go over. There's obviously more other ones that you'll encounter, but these are the 3 big ones that you should learn about. First one is the sponsor. That's the asset manager. They're the captain of the crew, right? They're the ones that are trying to execute on the business plan and steer that ship. And ideally, this is probably the person with the most experience in the real estate world. Ideally, they've been through at least one real estate downturn / hitting their target returns in that period. I know quite a few experienced investors now who, they might not have always hit their target. But this investor, for example, that I known has done 30 projects and 2 of them maybe didn't hit, right? And that to me is, I would rather pick someone like that than someone who's never failed, but has only done 2 or 3 projects, right? Then there's the property manager. You should learn who they are, but the important thing with this property manager is that they actually do the day-to-day work. This is the crew. This is the person that's going to be manning the ship and hiring and coordinating the maintenance staff. They do most of the on-site work. And so ideally that property manager is somebody who's handled a building like that before, whether it's a multifamily building that's 100 units or it's a commercial building that has retail tenants. You'd want somebody who's done that asset class before so that you can have confidence in them. People have different preferences on how large this property manager should be. There's some property managers, for example, that handle tens of thousands of units nationally. I personally prefer smaller property managers that might do 2,000 or so units, but they're really concentrated in an area. So they're specialists, but I also have more leverage and negotiation with them versus a large company. For example, if you try to fight McDonald's and get a bigger discount, that might be a little hard. But if you can, fight against McDonald's with 20 or 30,000 people rallying against them on Twitter, you might be able to push the company to change a little more, for example. And so it's just a question of, do you want to be a bigger fish with a small pond or a smaller fish in that bigger pond? And then finally, the person you're most likely to encounter is the co-sponsor. These people are typically your fundraisers, investor relations. They're often given a minor task within the role, but their biggest contribution usually is helping people get invested in that project. And it's likely the person that you end up meeting rather than just the sponsor or asset manager. But this person should be very knowledgeable. They should know the project inwards and out as well. And they should be able to answer these questions as much as you can. And ideally, they've been somebody who's invested before themselves with the main asset manager or sponsor. That way you can limit your risk. And these are questions that should all typically be answered. That way you can figure out if this person has invested before. Well, they've taken the confidence of giving their money first and putting that at risk before you invest your money with this co-sponsor, for example. So those are the big three of who's doing what. You should remember these. They're going to be pretty important, especially as you talk to syndicators of figuring out, are they the person who handles just investors, or do they actually run the project on a day-to-day basis? All right. Now, the other question you want to figure out is, how invested is the person who's investing this money for you, right? This asset manager, the sponsor, the GP team needs to have enough risk involved that they're going to take care of your project, right? This question of how invested they are can be broken down into a few sections, but these are the biggest four that I usually take away when I'm vetting my sponsors. One, how much money do they have in the deal? The biggest thing you have to be worried about here is, what is that money that they have in the deal once you subtract the acquisition fee? And I personally like to see at least 10% of the money being raised is being placed by the capital sponsor team. Obviously, the bigger the raise goes, it doesn't have to be 10% because then it becomes a lot higher, that number. But for example, the reason I mention the acquisition fee is, if I am investing in a sponsor and they said, hey, I'm going to invest $1 million in it. I'm like, that's great. What's the acquisition fee? Oh, it's $1 million. Well, then how much money do they actually have in that project at the end of the day once they close? It's basically zero. They've put the money in and they took the exact amount of money out of it. And so at the end of the day, they've actually removed the risk that they were going to put in this project at the end of the day. And so you're kind of on the hook for paying them to stay in the project, but now their invested capital just went right back into their pocket once this project closed, right? And so that's why it's important to ask not just how much money do they have in the deal, but what is the money in the deal once you subtract out that acquisition fee? Then the question is, do they have friends and family in these projects? And if they do, ask to talk to one as a referral. If they can't convince friends or family to invest, that might not be a good sign, right? You would imagine that the people that they can get to trust them the most would be people that they've grown up with or have known for a long enough time. Some people agree, some people disagree with this, but it's a metric that I like to use. And then another question people often ask, or at least I'll try to ask, is, are they full-time in real estate? I prefer someone with their full attention in the industry, but that doesn't mean they're going to perform poorly. It's just that I would prefer at least the asset manager or the main sponsor to be someone who's full-time in real estate. Co-sponsors are often people who might do more than one role, but they aren't as necessary for the daily operations of the building. So that to me isn't that important. So if they're a co-sponsor and they're connecting me to a project, then it's fine, because oftentimes they might have another role and whoever this asset manager is likely doesn't actually want to deal with raising money. And that's why they usually bring on co-sponsors to handle it for them. And then finally, how visible is their public reputation, right? If they're putting their name out there and sticking their name on a project, for example, a lot of people might have joined and seen Bigger Pockets at some point. Brandon Turner doesn't attach his name to projects that he knows is going to fail because that's his reputation online. Everyone knows who he is, and having something fall apart means everything else for his business falls apart, right? And so that to me is something that I would consider in terms of how visible is a public reputation. Not only does that force them to be more careful on their projects, but you can also see if they've been not succeeding on projects. So we'll talk about this later, but there are people who are very visible that you can now see, have they performed well or not? And that comes with the public reputation portion. Why do I say that? Well, Grant Cardone, for example, is somebody who is very well known. He advertises a lot on social media, but often has worse returns for his investors because his cost of capital is lower. He's very visible, and it's not hard to find a Google search of somebody who's invested with him talking about his actual returns and what it actually looks like. And so that's what I meant when I said, how much risk are they putting with their name out there, right? For someone like Grant, his cost of capital is incredibly low, right? But because there's so many people who've joined at this point, you have the ability to search and look up how is he performing with the investors that he's given these promises to, right? And so that's something that I would say is pretty important. Then on top of that, how is the sponsor going to be unique compared to other people doing the same thing that they are, right? What is their skill set? What makes them different that other people don't have? And that might take a little time, but that's the benefit of going on something like Palace, which is a way for you to shop between general partners and figure out who is doing best. You asked for references, wouldn't that be for the cap raiser, not the big head general partner? Can you talk to the big general partner sponsors? And oftentimes you can. If you ask them, hey, can I have a conversation? I don't think they'll typically say no to that, but it depends on how big the check is, because for the larger the investor, the bigger the check that it has to be for it to make sense to have that conversation with the head sponsor, right? There's a reason why typically the main GPs or the main sponsors will try to bring on co-sponsors, because then they can push more of that investor relation work to other people. That being said, what makes them unique? You can keep going from here. You ask, how's it different from other people in their market, but also how do they find deals? That's usually a pretty important part, because as you saw earlier, there's 3 parts to every deal, which is the experience, the deal, and the money. So how do they find that deal? Everyone says off market, but off market oftentimes means that it's done through brokers, because in the commercial world, there's not really a listing service. Yes, you have Crexi, yes, you have LoopNet, but those are where deals go to die, quote unquote. Those are the deals that didn't transact off market. And 90% of those deals typically go through a commercial broker. And those 90% of deals that go through commercial brokers, usually it's only 4 or 5 per city, per asset class that run the city's transactions. That's just kind of the way the commercial industry works. You have a harder time breaking in from scratch, and it makes sense because, again, they make money from commission, and so they want to be cautious about who do they hand these awarded deals to, because they want that project to close, right? And then finally, one thing that you can ask to see what makes them unique: what is their specialty, asset, or location? If there's somebody who's buying Sunbelt value add multifamily, I got to tell you, that's a dime a dozen right now, right? That's the most common type of project people pitch, but it's also because that's what people have said that they want to invest in, right? And so it's this demand supply fight between the two that has led to Sunbelt value add multifamily being one of the most popular, well-known asset classes for people to invest in. But if you're just starting a syndication, you might say, hey, this seems like a cool project. And if it's your first time hearing about it, you might say like, oh, wow, what a unique product. And then once you start going and meeting people who are in the space, you realize everyone's trying to invest in these types of products, but they're not wrong for doing it. You know, Sunbelt is where the population is growing the fastest. It's where the jobs are growing. And there's a lot of metrics that support the real estate in these areas booming and growing and continuing to grow, right? And so you can't, necessarily knock somebody for saying, hey, I'm doing value add Sunbelt multifamily, but there's a lot of competition, and you have to figure out, how do they stand out? What do they do that's different than the other people in that market, right? clearing my throat. Now, that being said, there's a few steps in the investing process that I usually take a look at before I might invest as an LP. Step one, it's the making your investment process. This is the portion where you try to figure out how organized is the person that you're investing with, right? This gives you a bit more of an idea. This is the dating period, though. That's usually when syndicators are going to be on their best behavior, right? That first date, they're not going to do anything messy yet. And so what they're looking to do is convince you that they're the person to place your capital with. And so this is kind of a bare minimum, right? Professionalism should be the baseline. It's not necessarily, it could also impress and outperform, but typically you want a base minimum level of organization and professionalism. Then you want to ask about their reputation and your relationship with them, right? Did they come through someone who referred you, right? Reputationally, my favorite way to actually figure out, is this a person I should be an LP with, is ask another syndicator in their same space to give an honest opinion of the other person, because who's going to be more honest than their competitor to some degree, right? Because that competitor is going to want your money the same way. So they'll drum up bad information faster and more knowledgeably than you could on your own, just Google searching, right? Because at the end of the day, these are private entities, so you can't Google for everything, but you can ask somebody who is knowledgeable, who's in the space, ask them about their opinion, ask how they feel about that syndicator. That'll give you probably more insight than anything else that I could imagine. So reputation, relationship, that's kind of another part of the dating process with a syndicator. And then finally, actually doing your own due diligence and making sure you have the knowledge to invest. I don't recommend investing in things unless you already have your first primary property. We talked about this in our first introduction portion, but if you don't have your own home yet, if you don't have a stable source of income, you shouldn't depend on syndications to carry you through entirely. At the end of the day, every investment comes with risk, and there are certain things that not everyone could predict. For example, COVID, where I know some people might have lost money if they didn't hold long enough into the COVID period. I mean, sometimes you just need liquidity. And so due diligence is key, but so is knowledge. Now, knowledge is the first step. You should know what you're doing. But due diligence, what I mean by that is ask for the Excel sheet, ask for documentation. One thing I ask for is IDs. I can keep them and it'll be a good background check in case they decide to pick up and leave and move to India overnight. That's something that you'd be surprised. It might be helpful because then you can actually do a background check and see, is this even a real person? But this is one of those things that I mentioned. This is a baseline. It doesn't have to be, the necessary parts of it. But my partner now that I'm working with, Chris Tao, he'll tell you, first time we invested together, I said, send me your driver's license. I want to see that you're a real person, ideally, but I was also figuring out and how to learn and understand what people's reputations were, because I didn't know everyone in the industry yet. I didn't meet a bunch of people in the industry yet. I was still flying blind, and that's likely what's going to happen for many of y'all when you're starting off. And I know for me, my mom, her first question anytime I invest in something, is it a scam? Like that. It's a classic Asian mom question. And I don't know sometimes. The step one is just doing my due diligence. And so that means I'm going to run through the math. I'm going to see their Excel sheet and were they organized? Were they professional about it, right? They might just send it to me in an email. That's fine. But I would rather see it in some sort of portal that's organized and put together. And that way I don't have to worry so much about, how are they changing the numbers constantly? And then we're going to go eventually into the underwriting and how to be conservative when it comes to looking at apartment complexes specifically, but also some commercial buildings. At the end of the day, it's, can I be reasonable with these estimates, or are they kind of trying to pull one over on me? And, at the end of the day, I don't think it's their fault for doing it. Syndicators tend to be people who are chipper. They're like brokers. They're going to be people who say, oh, this house might need some TLC, but it's the best location. It's got this and that. That's great. They're trying to convince you it's good despite some things being bad. And it does take a bit of work to figure out, the due diligence, because they're not trying to be a bad person, but they're incentivized to make things sound good when they're pitching you the project. So that's the first one. That's pretty much what I do when I am looking to make the investment. This is what I'm doing during the dating period, or first date specifically. Now, the question is, what happens during that investment? We are now in a relationship. I am working, with whatever syndicator that I've given my money to. We are married for the next 3 to 5 years. Communication is pretty key in this at this point, and transparency. Not everything's going to go right, but I would like to know ahead of time when things are not going right. I've had projects where there's a sponsor that invests with their industrial asset. They do commercial, and they warned me 6 months ahead of time, hey, this tenant is about to lose this lawsuit. And we think if they lose this lawsuit that they have with one of their biggest, they're a factory, they produce parts, and one of their biggest buyers is now suing them for whatever accident something caused. And if they lose this, they're likely going to go into bankruptcy. And so that's not something that anyone could have predicted. And, at the end of the day, though, they warned me ahead of time. And by the time they sold the asset, I was like, okay, they let me know what was going to happen. It did happen, but I was prepared for it. And that's what matters the most. It's not like you were sidelined. If you've been following the news, there was a syndicator out in Houston, 3,200 units went bankrupt. The syndicators newsletter came out one day prior to that foreclosure that said, hey, we're going to go into foreclosure. Things aren't looking too good. And then the next day they lost everything, right? Everyone who invested. But even then, I feel like that conversation should have happened much sooner, but obviously most of the investors are kept in the dark until it happened. And so that's what I meant by communication transparency. Things don't always go right, but it's nice to be told when things aren't going right. And that's where the communication comes in handy. That and just being consistent about outputs and memos. Q1, Q2, Q3, Q4, they typically follow the financial pattern for the fiscal year. So Q1 is January 1st, then April 1st, then July 1st, and then, so on and so on. And then it starts every quarter. So 3 months is usually what I get. If they were starting to give me emails every week, I would actually be annoyed probably because, hey, I'm investing as an LP. You don't need to tell me everything that's going on, right? But some people might want that. And that depends on your relationship with the syndicator and that conversation you had before investing. Because some people, especially for their first investment, want to know exactly what's going on all the time. That should be discussed beforehand. Other people, they invest because they want to be a limited partner who's hands off. They're just waiting for a quarterly update. And if there's any big news, you better tell them about the big news. But that can wait, 3 months at a time because syndications, real estate, a lot of these assets are not Bitcoin. You're not going to lose half the value overnight. It's usually a slower, longer decline. And, the thing is, if that were to happen, I'd want to know ahead of time and, figure out what is the plan to avoid this issue that is going to hit all of us at some point. And so communication, transparency, that's what happens during this dating period in the investment. Timeliness, like I mentioned, is that making sure that memo comes out on time, but also that you get your tax forms on time. Some projects don't always get the tax forms. I would like to make the process as easy as possible for myself. And so if I can get the taxes ahead of time, that way I don't have to push my taxes every year like I currently am for my own personal taxes, that'll save me effort from trying to chase down, hey, where are my tax forms? And then finally, distributions. This is obviously key. This is the little gifts you get from your partner along the way when you're dating. That's kind of the best part about syndications. It's so that you can get these quarterly, checks in the mail or right into your inbox, and you don't have to think about it, right? Mailbox money is the term. You want to clarify, when are distributions coming? When do they start? Because there's a lot of projects that it takes a while before the money actually starts hitting the bank, especially given that some projects might be really, really large value add, right? And so that matters when it comes to how am I going to get paid, but when am I going to get paid? And those are things you want to clarify before you make that investment too. But those are things to pay attention to during the investment. And then finally, the project, when it sells, this is a big day for everyone because this is the biggest check that you're likely going to get. You're going to get your investor capital back likely. You're going to get, on top of that, a profit ideally. But once you do that, you actually want to do the overall investor returns calculation. You want to make sure that the numbers come out to what they said it was, and then look backwards and see, hey, am I being rug pulled over, right? Behind all these fees, behind all these numbers, what did my actual return look like? And that's something that's pretty important for you to take a crack at, because otherwise, sometimes people just don't pay attention, right? They just let the money come and then they don't realize what actually happened along the way. And if you invest in enough LP projects, eventually you'll start to see there's some clear winners right now in these projects. There's some very obvious people who are outperforming and maybe not performing as well, but they were clear about communication on that. And those are all things that are going to play into your future investment, because that's ideally the goal, what you can do with these projects. You can double your money and then do it again and then quadruple and et cetera. And so that at the end is something that you should do. Look backwards on the relationship and see how did it actually perform. And finally, communication. I know I mentioned that this is important during the second part. I'm talking about communication after the investment is done, because sometimes people just give you your payout and then you never talk again. Ideally, I would like to stay connected to my sponsor because I want to give them more money, right? I want them to keep performing well. And if they grow too big, sometimes it gets harder to discuss, but it's the after investment communication that I find valuable. There's the sponsor that we had 2 projects that didn't go well. One of them wasn't their fault. And so I've gotten my money back, but they haven't stopped communicating with me. They haven't stopped trying to talk and say like, hey, just checking in. Hope you're doing well. I'm in town. Let me know if you want to hang out. And that to me is meaningful, because it didn't feel like, hey, this transaction just went bad and I don't want to talk to you again. I've seen some projects play out like that for other people, but ideally I would like to stay in touch even after the project finishes, because it doesn't feel like just like a one and done thing, for example. And so that's what I meant. So for me, that's my process, from the dating stages of that investment to what happens when we are in the relationship, and then finally what happens when that relationship ends. Do we still communicate? Do I actually do the math? How did it actually look? And I feel like a lot of people never make the actual reflection on what the project ends up being, because one thing I've noticed, for example, in the last 2 years, everyone says, hey, I'm a genius. I made so much money investing in syndications. And then I'd say, how did you operate compared to everyone else in that market? How did you do compared to everyone else who might have put a syndication money into Phoenix or bought their own house in Phoenix or Austin, right? Of course they looked great, because everyone did great in those markets. And so that's where it comes into handy, is looking backwards and seeing, did they perform well because they were good or because something carried them? All right. Now, I'm going to go over a quick case study about a certain project that I was asked to invest in, but I'm going to answer your next question first. If you don't see a distribution quarterly, does that mean things are bad? No, not necessarily. Right now, a lot of syndicators aren't giving out quarterly distributions because the market's getting tough, interest rates are getting higher, and a lot of us are expecting higher vacancy or lower rents. It might just be a way to build up reserves and protect yourself from future risks. And honestly, if somebody weren't doing that right now, or giving me an idea of like there's a plan to protect themselves, I would actually be kind of scared, right? I don't know if they don't pay attention to the news or don't see what's going on in the world. And I would imagine that there has to be some sort of plan, and that communication piece should come in handy once those distributions stop. And most of the time, once that distribution stop happens, there has to be another call to convince me, hey, this is why we're investing again. Hey, this is why the project is still good. And that's kind of something that I've been taught in recently from people who are smarter than me, which is if you ever do a bigger capital call, you just have to reconvince them why the project is worthwhile from the beginning. And you end up having to give the presentation all over again to show them that the project works. This was actually advice given to me by Paul Peoples. He's done like thousands and thousands of units. And so I hopefully can take that to heart. So now, case study. This was a project that came across my desk. It was about 300 units up in North Dallas. It had fallen into disrepair. A New Jersey landlord who was not taking care of the building or tenants at all had let it fall into disrepair. Half the buildings weren't even paying utilities. So the city had actually cut off their utilities. It was obviously going to foreclosure, and they were trying to beat it to the foreclosure mark. And so they were selling it originally for, I want to say 13, 14 million, which is basically the price of the loan. The project would have been worth about 25 when it was done. But the problem was one of the buildings of the 8 was already burned down. A bunch of them were paying utilities. This was a huge mess. It would have cost a lot of money to renovate. And I looked at that $15 million bill and I said, I can do maybe 10. And so the only way to get it to 10, which is below the price of the loan, is you have to let the building go to foreclosure. And then you bid on it on the auction block. So I had the capital lined up. I had investors who were ready. And then I just so happened to have encountered another syndicator who said, hey, actually, I already have it under contract. And I said, how much do you have it under contract for? They said, 15 million. Are you interested in funding this? And I was like, I don't know what to tell you. You should have let it go to foreclosure, because what happens when you go to foreclosure is that you wipe out all other liens beforehand. This building hasn't paid utilities. It hasn't paid a lot of things, likely contractors, likely people that they've managed to anger in that town that they owe a lot of money to. And if you go to foreclosure, it wipes out all of those loans. This person did not let that happen. They just bought it right at 15, price of the loan, thinking that they're going to make the money back. The sponsor had also only been in real estate for about 2 years. They were in the military for 13 years prior. They'd managed about 50 units before then, which is still impressive, but not the same as 300 units, which is what they were going to be taking on. They didn't have any friends or family capital, and they didn't have much of their own capital, which is why they were looking for investors. I was surprised they got it under contract. They spent $80,000 paying the utility bill for the previous owner just to get it under contract for themselves. And that's why they were so keen on trying to close at it, even at a $15 million price, which at that point, you basically make no profit for 2 years of work trying to get it renovated and back up to speed, because these buildings needed a lot of work. A lot of them were condemned. Most of them were half empty because the people left once the utilities got turned off, right? And they didn't have much capital to invest, which it sounds biased, but do you want to invest with somebody who doesn't have money? It sounds bad. You would want your sponsor to have a bit of their own capital to take a risk on, but also you want to invest with somebody who hasn't made money yet, right? It feels that's up to everyone, like how much risk you want to take on. But if it's somebody who's already made money through real estate, it makes you a lot more confident that they can hopefully make more money, right? If they can't make the real estate money for themselves yet, why would you give them yours? And so that's kind of the general idea that I'm trying to get to. Now, in the commercial world, you really shouldn't send emails like this. This was an email from the guy. The company name is Renovation Capital. When he sent me that he had it under contract, I just didn't really reply because I was like, yeah, there's no way I'm going to get anywhere close to $15 million. That's a huge red flag that he already doesn't know what he's doing, given his sponsor profile when I looked it up. He replied this email at, I believe, like 2 or 3 a.m. one day, assuming no interest in funding this, question mark, and that's usually already a red flag of organization skills and how likely are they to actually put this together. And what surprised me, though, was a few weeks later, he said, circling back, we didn't see you at the offer table, so we closed on it ourselves. And I was very surprised that they managed to close on it. And in fact, I thought they were just going to wait for it to go to foreclosure like everyone else thought they would. But instead, they bought it at $15 million. Now, here's the crazy part. I know the lender that they took on. So this lender and I had this conversation. They actually were joking about it. They were like, yeah, we just gave out this ridiculous loan. It was 18% interest rate, 1 year to pay us back. And then it was 60% LTV, which meant that this person found somebody to commit $5 million down payment for a $15 million project. And, and so he was trying to be snarky, basically saying like, hey, you didn't fund this. We close on it anyways, and I'm just more impressed that they were able to do it. But I knew their loan situation. I knew what was going to happen to them in about a year. And so I said, hey, circling back, congrats, best of luck. And I said, I didn't want to step on any toes, but if it doesn't work out in a year with Churchill, which is the name of the lender who I knew, I'm happy to revisit the conversation. What that tells the person at Renovation Capital is, if this doesn't succeed, I already know your loan situation. I already know what sort of equity you're stuck with, and that if you don't pay this back within 12 months, they're going to take everything anyways. So I'm happy to have that conversation if you want to sell it to me at a cheaper price. That's what I was trying to get across. And then lo and behold, he said, oh, our equity partner has liquidity issues and needs to be recapped. What that means is the partner who gave them 5 million wants out of the 5 million now. They want their money back. They want to get out of the deal. And they said, we're going to have a new bridge loan coming in about 2 weeks, and they're looking for $4.5 million of equity, which is, fun fact, exactly how much the last person put in the project, right? And then he asked, would your group be able to take a look? And obviously I'm not going to let, waste time here and continue from there. I'm looking for them to get foreclosed on and then buy it from them on the auction block when it's done. So that being said, I've also had really good syndicators, and this is an example of one that I've personally invested in myself. If you can't tell, Park South is the name of the project, but there's 101 pages in this investment packet. I don't know if y'all can zoom in. It's a little small, but this sponsor has been doing development for about 30 years and averaging 35% annually for the last decade. They were developing for someone else for 20 years prior before starting their own company. 35% is what they did for the last decade. This doesn't actually include any of their COVID projects, because their COVID projects were doing 200% annual returns. And they were just like, this is ridiculous. We can't ever post this anywhere because this would mess up all of our numbers historically. And we just can't repeat this again, because they bought it before COVID prices went up, and then they sold it, they bought it when construction prices were below, the inflationary period. And then they sold it, late 2022 at a huge valuation boost. Right. And so what they were saying was, this just isn't really possible. Again, we can't tell investors this is our number, but we're moving that, 3x return in 2 years. They still did 35% annually. So what that means is every 2.5, 3 years, they'll double your money. So they currently have 3,000 units under construction in town. They're also vertically integrated. They own their own property management company. So not only do they build the building, they actually manage it afterwards. And then they're also the biggest developer in that metro region. They're also major philanthropists. So there are buildings with his name on it at the local college, and they only take investors from friends and families and their referrals. And then they make a personal minimum investment of $1 million in every deal. That 35% is what the LP makes. So LPs are doubling their money every 2.5, 3 years. And the minimum personal investment of 1 million, I've seen him go 2-3 million into his own projects before in the past as well. Right. And so that's somebody who trusts their own projects a lot, and somebody who is taking money only from friends and family, which means there's a lot of risk that they're taking on because they're going to ruin a lot of their personal relationships if it doesn't work out. And so that to me indicates how much they're willing to commit to make this project work no matter what. So the reason why I know they've been a good syndicator and why they've actually grown to be so large in the first place was they broke ground the day the money all hit the bank for the lender. They started putting shovels, they started digging. This is what it looks like on the right after 2 quarters. This is 6 months of progress. And this is the fastest that I have an LP who's invested in other projects. His name's Haley. If you guys know him, he's in SARE. He's like, this is the fastest I've ever seen a development project go up. I agree. It's, same thing. There's 2 reasons for that. One, this is an affordable housing project with a lot of tax breaks. That's where the returns come from. And then the other is that this developer has a major relationship with the city. He sat on the council that determined where the new train line would go. He's done a lot of things that kind of shaped where the city was going to go towards, including his own investments. And that's a crazy thing about real estate, which is that you can do insider trading. You can actually dictate how the city gets built. You can't do that in stocks. That's the only thing you can do in real estate. And so on average, he typically finishes about 6 months ahead of schedule. And so this building is likely going to be done about 18 months. It's going to take another 6 to 9 months to actually fill it up and then sell, right? And so the project is projected to close in about 3 years, but average close time has actually been 2.5 years, which is, like I said, 6 months ahead of schedule. And I mentioned it before, this GP takes like a 40% GP split, but is still able to double investor return every 2.5, 3 years, right? And so I think I've mentioned this in the past. It doesn't really matter how big of the pie you're taking. If the pie is, or the share of the pie, I'm fine with a smaller slice of the pie for a bigger pie, right? And I've seen this happen time and time again for this investor, right? And so I'm happy to give 40% away, which typically this number is closer to 30%. I know people like Tony, for example, only take 18, right? If he's in this chat. And so, that's just an indication of how successful this person's been, but also how cheap his cost of capital is also, and his access to investors. I've seen him fill up $20 million in 2 days, right? So Nick says, what is the usual required investment with deals for someone like this? $500,000. And so I've co-sponsored for this syndicator before. And, that's kind of the purpose of co-sponsors. He doesn't want to deal with anyone with less than $500,000. And so I put together a small fund before in SARE, $50,000 checks at a time, just to get to a number that's worthwhile for him to talk to, right? And so it's something like that where it really depends on what your appetite is for giving things away, but also the syndicator themselves use co-sponsors because they themselves don't want to deal with someone who's only giving $50,000 or $25,000 check. They have a minimum number, and they've set it at that for that reason. Every person you have to talk to is a new name to learn, a new relationship to, retain and control. And so it's better oftentimes to find a co-sponsor, somebody who can sort of middleman that investor relation role. So, and then, this project is probably going to finish well ahead of time. And one of the books that's helped out the most is The Hands-Off Investor. A lot of the things that I've said here are also in this book, and they'll actually have more questions if you want to follow up on that. So that being said, that is the end of this session. We're going to talk about commercial real estate basics and more underwriting later on, but that was screening sponsors today. I'm going to start taking questions now. So Lucy asked, what are typical fees? You mentioned an acquisition fee and a GP split. So there are no acquisition fees on his projects typically. He already takes a big enough equity cut, but he does take a cut for a developer fee, which is based on the cost of construction. Let's see. I mentioned an acquisition fee and a GP split. Some projects have an acquisition fee, especially for value add ones. So for example, if the acquisition fee is 1% and I buy $1 million building, then the syndicator takes 1% of that 1 million to pay themselves for the work that was done up front to find the property that was worthwhile, right? Because for every property that gets raised, there's likely, a couple dozen buildings that weren't worthwhile. That's plane tickets, that's time spent out of your day to travel to it, that's underwriting, that's, broker relationships. It's a lot of work done ahead of time to buy the property. And so that's where the acquisition fee typically comes in. And then the GP split, what that means is when you sell a project, you are typically splitting up the fee in more than one way. The best way I can explain it is here. Let me pull it up and screen share. So if you were to figure out what a syndication split looks like. I know we talked about this briefly in the intro, but I can go a little deeper in it. Let's imagine the syndication deal looks like this. It's yellow is the loan, and then 25% of it is investor capital, right? You then might have this thing called the preferred return. It's kind of like a loan, but what it means is whoever is investing as an LP gets paid 8% first a year, or 10%, depends on that number for return. The GP, the syndicator, is not allowed to take any money out until that preferred return is paid to the LP. So when you actually break out a project and sell it, this is what it looks like, assuming that the project made money. So this is the loan when you sell the building, and this is the return of the investor's money, right? So this is what the original project, the dollar amount looked like. If this was, say, $1 million, right? It would all fit into here. Return of capital and then paying off the loan. Then you have closing costs. And then you also have preferred return. So if you're an LP and you had an 8% preferred return and it took you 3 years to get paid, you'll get 24% back before there's any LP or GP split. So these are all below the line for the profit share. If I have $1 million building, my investor capital pays first, my loan gets paid first, then I have to pay my fees for my lawyer and my agent. I also have to pay my preferred return to my investors. Once that is all paid, any money left over, that's my GP LP split. So most GPs take 30% of this profit on a normal project, and then LPs get the other 70% of profits back. And then it gets split based on how much money you put in, right? Does that bring clarity, or is that still confusing? Okay, I'm going to assume that's clarity, but if this graph, yep. Yep. Sorry, can you repeat that?
I said that makes sense to me.
Okay, awesome. So I'm trying to graph this in a way that's understandable. If it's not, please tell me, because then I can draw something better, hopefully, and it makes more sense. I know graphics tend to be easier for most people than just straight numbers. And so I'm trying to really emphasize that this part is just what was paid for the property. And if this bigger share of the square is actually what we sell it for, then there's a lot of profit to be split up, right? And that's all I'm trying to indicate. So, okay. Let's see. Is the split determined upfront or at the end? Does it depend on ultimate returns? If the returns are lower, do their profit split change? No, the way the preferred return structure works is that if the project makes no money, because of how preferred return is, the GP doesn't take any money from the sale. They only make money if the preferred return is paid. If the preferred return never gets paid and the project actually loses money, then the GP gets no money, basically. And that's why a preferred return is typically safer for an LP. But to trade it off, most GPs, if they only do a GP straight split with no preferred return, they'll usually take a smaller cut, right? Okay. You asked, is it a good thing for syndicators to run their own PM companies? Is it manageable? Yes and no, it depends, right? Most property managers are not profitable. Up until about 6,000 units of under management, I've talked to quite a few people who've owned their own syndication business and their own PM business. If they own less than 6,000, a lot of times they sell off that business because the property management side isn't that profitable below 6,000. The reason for that is you don't really set up your systems properly, and above a certain number, for example, once you get to 100 units in an area, and then you have 5 buildings at 100 units, you have to hire a regional manager in between. That regional manager is a 6-figure salary. And so that kind of kills a lot of the profits you would have otherwise made in that space. And so you have to get to a big enough scale to afford it. This is specifically for multifamily. I don't know what it is in other asset classes that much, but at least in the multifamily space, the syndicators that I've talked to, the people who have run their own businesses, oftentimes being aligned with your PM company is actually better. You end up getting a faster turnaround in terms of policies and things you want to see in place. The biggest problem is it actually limits the scalability in a lot of ways. If you run your own PM business and you do great in Florida, it's gonna be hard to bring that out to Atlanta. You have to create a brand new system. You have to hire a bunch of new people, and all of a sudden you're taking more risk by, entering into a new market. Whereas if you work with a third-party project management company or property management company, oftentimes you can shop through them faster until you get somebody you like. I know this is something that Tony Lynn does a lot to figure out who he can work the best with. And oftentimes it might not be the company's fault. It's who's the actual on-site property manager, right? And that person might need to be swapped out a couple of times. And the bigger companies, you can do that faster. Smaller companies, they might have a harder time hiring good talent, right? And so that's kind of what happens when most syndicators start off running their own PM company. But there's perks, there's minuses to both. I personally am leaning towards the side of not running their own PM company, because sometimes then you don't have aligned interests. What this means is, as a syndicator, because they're charging you money through the property management, they can add extra costs, kickbacks, et cetera, to pay themselves through the property management side. So they're getting paid in both sections. Now, there's not exactly a separation in terms of the asset management, who has investor returns in who has investor returns as their most important thing, versus the returns of the property management company, right? Because oftentimes those kind of are at odds with each other, right? And so that to me is why I'm not that big of a fan of necessarily having syndications that are also self-managed, because the sponsor is getting paid from both sides, and I don't know which one they lean more towards, so. But at the same time, that's really up to you to decide how much you do trust that person who's operating, and will they have your best interests at heart, even if they're paying their PM business whatever amount on the side. So that's why, for example, I invest with the other sponsor that I mentioned earlier as an example. So does anyone else get paid like the co-sponsor? Could you explain what you mean? Like, does anyone else get paid like the co-sponsor?
Oh, because you mentioned like there's syndicators, there's GPs, there's the co-sponsor sometimes that manages investor relations. So I'm just curious, like, what are all the layers of fees that get taken out?
Yeah, there's a list of them. I put them up on our Notion, but I can go through them briefly. So let's see here. So there's a list of them, but the people I didn't mention, one was a key principal. There's somebody who co-signs the loan for the sponsor to qualify for the loan. Oftentimes, you're buying $100 million buildings. The sponsor might not necessarily have $100 million to their own name. So what they have is somebody significantly wealthier that co-signs on the loan to qualify for the loan. Because one of the things that the loan wants is that you have a minimum net worth that's equal to the loan, right? And so I've seen key sponsors usually charge 0.5% to like 1% of the whole project just to be on the deal. That being said, okay, what are some fees that you might have to watch out for? This is going to be in the structure part, but I'm just going to run through it real quick because this is the question I was asked. 1 to 5% of the purchase price, depending on how good the deal is, right? Another one is a refinance fee. So this is often called a capital event fee or exit fee. It takes work to sell a building. It takes work to refinance a building. There's a lot of paperwork. We're putting close to, 100, 200 hours right now on this refinance that we're doing on a building. And so the documentation time, because it's so extensive, usually there's a fee associated with it. And that's usually 1% of the price of the loan on the exit or on the refinance. Basically, whatever amount of money is returned to you, that is typically the, it's based off of that as the fee. So disposition, exit fee, same thing. Property management fee. This is what I was saying is if the owner owns the building, they will usually charge the fees of the property management company back against the project. And, it's kind of easy to like increase the fee if need be to like make your property management company profitable. So it really depends on the sponsor, if you trust them to, manage the building and not gank you on the price. And then there's a developer fee. If a syndicator is charging this and hiring out construction work, usually they will either take the money for the construction development fee or they will use it to pay whoever the developer is that they've hired out as a general contractor. And so I see this most often in like bigger, complex construction projects. And so, but this is pretty reasonable, and they often need this to pay off a lot of their initial staff, because most construction projects don't sell for like 2-3 years. And you kind of want whoever your sponsor is to be fed and be able to pay their staff. You don't want them to be cash flow negative, especially for a development project, for too long. And then there's an asset management fee. This is usually charged separately from the property management fee, and it's supposed to cover your admin costs as a syndicator. This isn't that big because only 1 to 2% of it revenue. For example, right now we have a almost $18 million building, and 2% asset management fee is only like $30K, basically. And so it's not that big of a fee, but it pays for a lot of admin costs and like one staff member basically to keep an eye on it for admin tasks. And so that's the type of fees that you'll typically see in a syndication project. Screening a sponsor team. I think I mentioned this early. How many people are too many on the team? There's usually 2 to 3 lead sponsors. Those are the ones you want to talk to. But if they have over a dozen sponsors or co-sponsors, you might question why they need so much help raising money for the project. Typically, if you do see like a large co-sponsor team, you want to figure out, is everyone actually on the asset management team, or are the majority of them there just helping fund projects? And so it really depends, but typically 2 to 3 is a normal number. 6 is really the most you should accept on an asset management team. And then in terms of too few, that syndicator who actually went and got bust in Houston with those 3,200 units, and he was the only GP on that project. So too few might be 1. That's really it. They just co-sponsored and partnered with other people on past projects, and then they went solo on this project that ended up getting foreclosed on. And so that's probably not necessarily too few. The sponsor that I invest with, for example, they're the only sponsor on it, but they've been doing it for themselves for, decade or so. And so that gives me pretty good confidence that they don't necessarily need a partner to tag along with them to make sure that everything works. And so it's a question of when you're sponsoring, when you're checking out these sponsor teams, too many is just, can you not even keep track of them all yourself, right? That's when it becomes kind of scary. But in general, 2 to 3 is good. Above 6, like, what's going on here, right? And usually you'll see a lot more co-sponsors than actual sponsors. And so you have to like clarify who's actually sitting in on these meetings, how many people are actually trying to drive this ship, because you don't want something with 4 captains necessarily. When talking to a sponsor, what kind of questions should I ask to fish out whether they are a cap raiser or an actual operator? Honestly, if you ask them, you should be frank. They should be frank about it. Hey, are you a co-sponsor, or are you like part of the asset management team, right? A lot of times they might say like, I'm actually just a co-sponsor because this team is really big, and it's not worth their time to talk to people who are only giving $50,000 checks at a time. And so I am here in the middle as investor relations for them. You're more than welcome to talk to the main sponsor, but I don't know what questions you'd be able to ask that would ascertain your fears or things that can convince you otherwise. But it really depends. Typically, most of the time when you ask to talk to the main sponsor, you're just asking them about how they run their business, their past experience, etc. I would just, I don't have an exact answer for that, unfortunately. Let's see. Is Tony still on here? Tony Lynn?
Yeah, I'm actually in a coffee shop, so I wasn't speaking up.
No worries. Welcome. How do you typically get past the, hey, am I talking to you as a co-sponsor, or how do I have a conversation with the actual sponsor?
Yeah, I shared this with some of the folks on the Infinity before. So basically, just like what you said, first of all, I try to see if they're upfront about it. So I'll talk to them and just basically ask, it's like, yeah, what is your role, right? So are you You know, you say you have 500 units or 700 units. So what do you actually do on these deals? And then they'll say, oh, no, I attend management meetings. I attend, like I'm involved in every day. Then I start to ask them some simple questions, right? So for example, say, okay, so you know, how much does your renovations cost, and where do you guys buy your materials? And I ask for things like, you know, what is your economic vacancy rate? You know, what kind of trouble have you guys been having? And then so just with a few questions, you can quickly figure out if the guy actually participates in the day-to-day. So most of the people get stumped by that, and then that's a major yellow red flag for me because he's pretending to be somebody he's not. And just like what you said, I'm perfectly fine if you're just a co-sponsor, you know, as long as you don't claim that you have the experience of running all those properties. And I actually try to do my best to meet the lead GP so that I can get to know them.
Yeah, thanks for that advice, Tony. If it helps, our average spend right now is 6,000 a unit. Our economic vacancy is around 12% still. So
6,000 a unit?
It's been pretty expensive, I know.
Holy cow. Wow, that's like super class A stuff.
We had a few units that like had flooded, and we had to really like jack up, you know, the turn on it. But the majority of them were pretty low.
Oh, I'm sorry. You meant. Oh, okay. The renovation cost. Okay, I was thinking like the rental was 6,000.
Oh, no.
No, I mean Nelson. Nelson knows what he's talking about. So no, I totally trust Nelson.
That being said, Tony's also a great resource. He's been an immense source of knowledge, even though we're competitors technically. I often ask him for advice on different projects. So likewise for Tony. You mentioned, I heard there's a SARE field trip to Dallas soon for SARE syndications. That's correct. We are doing one for October. We're going to be attending Paul Peoples' event, Alt Capital, with James Zhang. He's actually going to be speaking at SARECon too. So if you want to get a quick sneak peek and meet him at SARECon, that's a great chance to get some FaceTime before actually flying out to Dallas, at which point his conference will be swarmed with other syndicators trying to talk to him. In terms of discount codes, we also have quite a few. Tony Lin helped us get them. So you have to reach out. Do you reach out to Tony for those, or do we give them out?
Well, those who are in the in Linfinity campus do have the code, but you guys should reach out to Tony to get the code.
I just posted it.
Yeah, the people in the chat can see it, but like we're Facebook living, so I am not gonna post that live across 20,000 people. So for those who are interested in learning more about syndications, go to the conference, hit up Tony.
Yeah. Either way, thanks y'all for being a part of this. We're going to send out the recording later tonight. That's us for the hour. Thank you all for attending.